Welcome to another episode of Financial 15. Kevin and I are ready to go. We're going to talk about CPP, specifically CPP and inflation. How does inflation impact CPP? Should you be taking it earlier, later? We'll get through all of that. You definitely want to stick around.
Yes, one of our favorite topics to talk about CPP, one of our most asked questions always as well. And today we're going to deal with CPP as well as inflation. Are the two, is there a big difference that goes on if you have to wait, or do you want to take it earlier? Again, if you want to get in touch with these videos or any of the others, please go to our YouTube channel and subscribe. Great content there. You'll find this, all our other CPP videos, as well as other topics we're talking about. Or you can like us on Facebook, and most importantly, visit our website at beckerorr.com. There is a lot there that you can involve yourself with and get to know more about the financial situation. But today, CPP and inflation, that's what we're going to talk about. But before we get into that, Clint, shouldn't we describe what the basics are?
We need a quick refresher on CPP, then we can go into the details of how inflation can impact CPP. So the basics here: CPP, a monthly taxable index retirement pension. So you get that amount and you get it for life. This is the program we all pay into. A quick note: Old Age Security OAS, different system. No one pays into that one directly. CPP, the Canada Pension Plan, that's the one we pay into. You pay into it, you get a pension. That pension's indexed for life. The more you pay in, the larger your pension. You can see some of the details there. 5.7% is the contribution rate, up to $64,900. That's an important number. We'll come back to that. But once you're over that $64,900 of income, you have maxed your CPP contribution for the year. Your employer matches your contribution, so they put money in as well. And if you're self-employed, you got to do both halves, Kevin. So it's 11.4% if you're self-employed. Here are the rest of the basics.
Yeah, it's lots of fun there. Yeah, and again, as we talk about it, the normal start age is 65. And at that point in time, the maximum pension for 2022 is $1,253.59. Now, that doesn't mean that's the average. People can take it as early as 60, or they can delay until 70. So we know that the average payment, though, at 65 is about $702.77. So again, you can take CPP as early as 60, but if you do, there is a penalty. That penalty, of course, is 0.6% per month prior to 65. So at 60, it's a 36% full deduction. Whereas if you wait until 70, you get 0.7% as a bonus. So you actually earn 42% more if you wait and delay. Again, normal start age 65, but you can take it early or late depending on what's going on.
And important to note, for those penalties and those bonuses, often when people think about when should I take CPP, that's the focus, right? It's kind of a break-even mentality. I take it early, I get the penalty, but I have a little more money earlier in my pocket. We don't believe in the break-even mentality. We have other videos on that, but we're going to talk about today how inflation can impact those break-even calculations. It kind of messes up all your math. It makes it a little more complicated for you. And that's really the crux here, is how does inflation impact CPP? And then we'll go through a couple of examples. So let's start with that first part, though. How does it actually impact CPP, the logistics? The first portion, there's going to be two. First one is if you're already receiving CPP. You already get CPP. Well, it's an income adjusted benefit. It's indexed. And what is it indexed to? The Consumer Price Index, which is calculated by Statistics Canada. You have the example there. This is the actual numbers. So in January of 2020, you would have got a monthly increase to your CPP by 1.9%. In 2021, they used 1%. In 2022, so January 2022, you got another little lift, 2.7%. They always use the prior year's data to do the adjustment. So the big inflation we're seeing now, that hasn't worked its way through yet, but that's the first way you can get an adjustment for inflation. Is if you're already receiving CPP, you'll get the top up. The second way that inflation can impact CPP here, Kevin, is if you haven't touched it, it impacts the formula.
Yeah, it does. So if you're still contributing, as we mentioned, the maximum annual pensionable earnings, sometimes called the yearly maximum pensionable earnings, easier to go YMPE, is adjusted to reflect wage inflation. And wage inflation is a big factor as to how much you're going to pay compared to what those numbers are. So you're using a percentage increase in 12-month average of the average weekly earnings in the industrial aggregate. Now, this is all calculated by StatsCan, and a lot of mouthful to put it there. But as you mentioned, the 2021, 2020, 2022 numbers, they don't count into what that inflation for what we're having right now is until 2023. So for 2020, as we saw, the YMP was 58.7. In 2021, 61.6, and in 2022, 64.9. So as you can see, these numbers are substantially higher than what you're getting off of the previous scenario that you're earning off the CPI number in regard to what we're dealing with if you're still contributing to CPP.
Yeah, so the growth rates between the two are not the same. They're using different metrics. They grow at different data points. And it's important to note the YMP, you might be thinking, all right, great. So the YMP is a little higher. What does that matter? Is the importance is that the maximum benefit anyone can receive, the YMPE is used to calculate that maximum benefit. So as that goes up, the maximum benefit also increases. You can see in 2020, the max at 65 was 1,175. It then went up by 2.3% in 2021, went up by another 4.14% in 2022. And that's how you get to the 1,253 that we currently have as our max. The point is the growth in that maximum historically, not always, but historically has been faster than the growth in the CPI. So the two ways inflation impacts CPP, and then your benefit is going to be based off of this number, however, based off of the maximum. So that's key to understand. So a lot of information there. We'll go through a quick example here, Kevin, to try to help it sink in. A couple of portions to the example. Why don't you set it up here for us?
Yeah, so I mean, basically, we're dealing with a source by Lea Koiv, an article consider inflation when deciding when to begin CPP on advisor.ca. But basically, what's going on is she's using the example of Cynthia, who is 60 in January of 2020 and qualifies for the max CPP. Now, if you take your CPP early, as we mentioned beforehand, you do have a penalty that's incurred. So even though the max was 1,175, minus the 36%, she's now receiving 752.53, or roughly 64% of that entire max. Now, that's if she started in 2020 and she is taking the maximum that she can get at this point in time. But as we go forward, there are differences that come out, aren't there, Clint?
We're going to do a couple of comparisons here. But first, that's a great point mentioning Leah's article on advisor.ca. That's really the basis of our video. A lot of great information there. So you definitely want to check out Leah's video. And you'll note that maximum, you can see the 1,175 and then the penalty. So she only got 64% of that maximum. So it's used in calculating her benefit. And a reminder that maximum grows at different rates. So we're going to see how that comes through. So here's the comparison. What if she waited a year, Kevin, waited until 61? So there's going to be two scenarios. We'll compare the first one. If Cynthia started at 60, like you just mentioned, she doesn't get the full amount. She's only going to get that 752. But if we carry this through our what if scenario, she starts at 60 in 2020. Well, when she's 61 in 2021, she'll get that inflation adjustment, which was only 1%. So using the historical number, that was the number in 2021. It was 1%. So it went up to 760. So if she would have taken it at 60 in 61, which is 2021 in our example, she'd have $760. What if she would have waited, Kevin? What would the number look like then?
Now, that's a different comparison. If she would have waited and started at 61, now, she's only getting a 28.8% penalty. She's not getting the full 36 because she waited a year. And of course, that extra 0.6 is gone. So she gets 64% of the max 1203.75, which would be 557.07 per month. Less penalty and the maximum benefit lived up. So by waiting 12 months, she's not just getting the benefit of the penalty, she's getting the benefit of the penalty plus whatever the gain would be. So that's a 12.76% larger pension. So as opposed to just the 1% that we're getting on one, we're now getting 12.76 more by waiting a year based on all the calculations for everything that we've done and the penalties that we're dealing with for CPP. So, $857 compared to $760, by waiting a year, she's getting almost $100 more a month based on this scenario and the effect of inflation on it.
And that's the key. That's inflation. And a quick note here on the slide, it says a 28.8% penalty gets 64% of the max. It should actually get 71.2% of the max. But the idea here is she gets a greater percentage of the max. The penalty went down through waiting, but then also because of inflation, the maximum you can get also went up. So you get a larger portion of a bigger number. And that's where you're seeing these gaps. And then key, I mentioned that break-even mentality earlier that some people might have. Often they just look at the penalty, right? They say, well, the penalty 0.6% a month, that's 7.2% for a year. I'll use that for my math. What we're seeing here is the gap's actually much larger when you consider inflation. And it's not consistent. This where it can get a little tricky. But if we do another example, and let's say she waited 2 years. Instead of taking it at 61, she waited until 62. So go through the first part of that what if scenario. So if she did take it at 60 in 2020, she would get her 752. At 61 in 2021, she'd get a top up because of inflation. She'd get another top up in 2022 at 62. And again, we're using the historical numbers. We're using the example that Lea Koiv did in her article on advisor.ca. So you can see through the inflation adjustments by 2022, she would have $780.58. Now, if she would have waited, Kevin, 2 years, what would that have looked like?
Yeah, now that would be a little bit more in regard to what she's going to get at the end of the day. So if we do it starting at 62, and again, remember, we're only dealing with numbers in a fairly small inflationary period so far. We're not counting what next year's is going to look like. But if she started at 62, all of a sudden we're at 21.6 penalty. She's getting 78.4% of the max. So that's $982.81 a month. Remember, that penalty, the less you have of it, the more you're going to keep at the end of the day. But if we less the penalty and the max benefits went up, just by waiting for 2 years, now she's getting a 30.6% larger pension, $982 versus the $780. So now we've increased over $200 more a month just for holding on for 2 years. Again, as we say, if you just back out, as Clint's mentioned before, the penalty and you don't count the inflation, that's one thing for the break even. But the minute you add inflation in there, all of a sudden these numbers become substantially larger than what you're going to be able to calculate otherwise. So an extra $200 a month by waiting 24 months or over 30% larger pension going forward.
Yeah, and the longer you wait, the bigger that inflation impact will be. And so we asked our initial question, how does inflation impact the CPP? Well, the impact of taking CPP early is greater than the stated penalty when you consider inflation. So it's not just the 7.2% per year. You're working inflation. It's actually a larger drawdown because of the way inflation impacts the CPP formula. So the higher the inflation, the greater the impact. And like you said, Kevin, the data we're using is really from 2020, 2021. We really don't have this year's high inflation numbers in there yet. So it's probably going to have an even greater impact if you have high inflation.
Yeah, so if you're going to wait, I would wait until at least 2023 before taking your pension if you can take it this year, because that's going to be substantial. And again, as we say, inflation provides an incentive to delay it. Not only you're not getting the penalty, but the inflation numbers added on, even as we've seen at small amounts, 1.9, 2%, it is definitely worth having that inflationary effect going forward for your CPP. That's something that you really want to consider. And what does that lead us to, Clint, down the road?
Yeah, I will tackle that in just a second. Before I do, a reminder, the article, we based a lot of this off of Lea Koiv's work on advisor.ca. Her title there, Considering Inflation When Deciding When to Begin CPP. So check that out. We'll put a link in the description again of all the data. She does quite the analysis there. But what it takes us to, Kevin, this is another incentive to delay taking CPP. Now, everyone's going to be different. There's more to life than just math. You have to find something that fits your situation. But often what we tell folks, and done other videos on this, so we won't get too in detail here. We'll link to it. There's an RRSP Meltdown strategy. The idea being if you have other RRSPs, that could be a tax burden. So perhaps delaying your CPP, that means you get this inflation working to your advantage, and then using that time to draw down your RRSP in a tax efficient manner. That could be a strategy. That can be a fit. We've done other videos on that specifically. It's called the RRSP Meltdown. But I think the bigger takeaway here, Kevin, is really you need to have a plan.
Yes. Yeah, that's the big factor. I mean, basically going forward, you want to have that financial plan. And this is part of the reason we do these videos and everything else, is to make sure that you know what the options are that are out there. Because most people don't think of CPP and inflation. They think of strictly the benefits or the disadvantage by taking the penalty early and not worrying about it from there. But this helps to incorporate that. This plus the RRSP Meltdown strategy, these can all come in handy to keep more money in your pocket at the end of the day. And that's basically what we want to get to.
Exactly. But finding a right fit for your situation, right? So if you have a plan, you can end up with something that's a good fit that'll maximize your retirement, which is fantastic. If you have other questions, whether it's CPP related or another financial issue, let us know. Chat with ClintonandKevin.com. You can see it on the bottom of your screen. We'd love to hear from you. I think that wrapped it up there, Kevin. Lots of talking on CPP. Anything else you wanted to tell the folks before we sign off?
No. I think we've covered a lot of this on CPP and inflation. View our other CPP videos. This will help out with everything going forward, but that's all we can say for today.
Take care.